A lot to digest this week, Tobias. So what are you looking at when you come into the office first these days? Is it Boeing? Is it Brexit?
So actually none of the above. I mean, I find these things somewhat distractions. We're looking at credit conditions, we're looking at earnings revision trends, we're looking at investor sentiment. To me, these kind of blips in news aren't really the market drivers. They are kind of things that capture a lot of news headlines. But if you're an investor, you're really supposed to look through the signal, not to the noise. And in that sense, for instance, we put out over the weekend a bear market indicator checklist looking at 20 different factors that are only showing about 20% of them, or 4 of the 20, signaling caution. They're not even signaling danger. In the previous periods, for example, in 1990, we had 69% of them suggesting problems, 89% in 2000, 55% in 2007. And in all three of those previous instances, the majority of the factors were in what we would call danger zone or extreme zones, not in kind of yellow or cautionary zones. So it's not just in the aggregate number, you know, what percentage it is, but also a little bit of a qualitative distinction in there as well. So we're not really seeing things that would indicate a terrible market out there. We do think sentiment is much more neutral. People have kind of missed this rally to some degree, and it suggests that the pain trade's probably a little bit higher. Our target's 2850 for the S&P, so we're getting close. We could overshoot, but we're a little bit more worried about the second half.
So if everything that we'll probably be talking for most of the rest of the show about is really just water cooler talk and you're keeping your eye on the fundamentals, Tobias, where is that pain trade going to be felt? You say there's a little more to go there.
So we think the cyclicals could still trade somewhat higher, that the economy obviously went through a bit of a rough patch around trade fears around the Fed, and that's kind of, both of those have receded a significant amount. There's some catch-up probably in there. They overshot on the downside as people got worried about recessionary conditions or potential for recession. And in that context, I would expect, again, some of these cyclicals to keep trading up, chip stocks trading higher. There could be bouts of volatility, so we do think some hedging is appropriate. But again, I think investors just really don't believe in the cycle, and you still have some opportunity there.